In this video, we're going to look at the different ways that economists and accountants have of interpreting costs and profits. Now, economists measure profit by looking at the difference between total revenue and the opportunity cost of all inputs, whereas accountants take only explicit costs into account when they measure profit, and they take away those explicit costs from revenue. So why do they make this distinction? Well, economists are interested in resource allocation, what it is that explains how resources are put to different uses in the economy, whereas accountants are interested in such things as the profitability of businesses because they need to report to shareholders, or they need to work out what a company's tax liability is. So economic profit is the difference between total revenue and the opportunity cost of all inputs. Let's give an example to help us understand this. Let's assume that I want to start selling some biscuits which are come from a family recipe handed down through generations, and I decide that I'm going to make these early in the morning at home, or largely at home, and that I will deliver them to the office when I go there to give my lectures. I use my brother's oven because he's got a registered bakery business, and I'm conscious of the health and safety requirements. So I need to do it in a registered business, do the baking in a registered business. Obviously, I purchase the ingredients myself and do the packaging, plastic bag, and I have about 100 guaranteed customers a week. And these biscuits sell, let's say, for $5 a packet. Now let's have a look quickly at the accounting that both accountants would do, and then how economists would view the same business. The revenue will be the same for both. $5 times 100 is $500. And the explicit costs are the costs that the accountant can measure. He knows that the ingredients cost me $100. The electricity for baking, I pay my brother $30 token amount to use his ovens. Packaging and printing, let's say, is $15, and explicit costs, let's say, of $145 in total, namely 100 plus 30 plus 15. If we take these away from the revenues, 500, we arrive at a rather attractive business with $355 profit. Now, economists, on the other hand, do not, when you look at it from an economist's viewpoint, the business doesn't look quite as rosy as it does from the accountant's viewpoint. The revenue is the same, explicit costs are the same. There's this $145, there's no difference in opinion there. But the implicit costs are quite different. For a start, the time I spend early in the morning doing the preparation and baking, and the other time that I have to spend getting the ingredients and distributing the product, these are represent an opportunity cost to me in terms of what I could be doing with that time for other things. For instance, I could be advancing my economist's career using my economist skills, publishing books, articles, advancing within the university, or whatever. Let's imagine that has a cost to me of which is worth $100. If we add in the fact that I now cannot do the baking myself, I'd have to hire a baker, $100 cost, let's say, and the distribution and purchasing cost, let's say, is $60. I have to lease a vehicle, and I'd have to as well use rented bakery space because my brother wouldn't want to have a stranger appear in his business early in the morning. He trusts me, but not necessarily somebody else. So if we add up all these imaginary implicit costs, we arrive at $350. So added together, in other words, the implicit plus the explicit costs, we get $495 per 100 packets. So taking that away from the revenue, we arrive at only $5 of economic profits. Now notice that those implicit costs, or those profits, incur what we call normal profits. In other words, the return to the entrepreneur that he expects out of the business. It's his next, in this example, the next best alternative he could do, namely to publish whatever. Let's represent this in a diagram. Here we have $500 total revenue, and that's the same for both economists and accountants. The accountants have an explicit cost profile of $145 for this business, and that leaves $355 of profit for the business. Looks pretty good. Now let's look at it from the economist's point of view. Same explicit costs, but of course when you start adding up the implicit costs, we arrive at $350 in total. And these are essentially opportunity costs. When we add them to the $145, we arrive at $495. That's $350 here plus $145, which leaves only $5 of economic profit. So, in summary, economic profit is total revenue minus all opportunity costs, which includes normal profit, which is the implicit return to the entrepreneur. In my case, it was how much I could earn not baking. And the accounting profit is total revenue minus explicit costs only.